If you've been watching your portfolio over the past few weeks, you've noticed something significant. Gold and silver assets that many had positioned as safe havens have experienced sharp declines. Headlines scream about plunging prices. Social media fills with panic and confusion. And yet, beneath the surface noise, something else is happening. Something quieter, something deliberate. This video isn't about predicting where prices go tomorrow. It's about understanding what's actually happening right now in global markets, why most people are interpreting these moves incorrectly, and what experienced investors are doing while others react emotionally. I'm speaking to you today as someone who has studied market cycles for years, not as someone selling you fear, not as someone promising easy wealth, but as someone who believes that clarity and understanding matter more than drama, especially when markets test our discipline. What you're witnessing isn't just about precious metals. It's a signal of deeper shifts in the global financial system, shifts in monetary policy, shifts in how capital flows during uncertainty, shifts in how professional money managers are positioning for what comes next. If you hold gold or silver right now, you need to understand what this moment means for your strategy. If you've been watching from the sidelines, you need to understand what opportunity and risk actually look like when separated from emotion. This will take some time to explain properly, but if you're serious about protecting wealth and making informed decisions, the next 25 minutes might change how you see this entire situation. Let's begin with what actually happened. Over recent weeks, gold prices fell from near record highs. Silver, which typically amplifies gold's moves in both directions, dropped even more sharply. For many investors who entered these markets seeking stability, this felt like betrayal. But price movements alone tell incomplete stories. What matters more than the decline itself is the context in which it occurred. This wasn't a normal market correction during stable economic times. This happened while several major forces converged simultaneously. First, the US dollar strengthened significantly against other global currencies. When the dollar rises, dollar-denominated commodities like gold typically face headwinds. This is basic mechanics, not mystery. Second, real interest rates, the difference between nominal rates and inflation, shifted in ways that temporarily reduced the opportunity cost of holding non-yielding assets. This technical factor matters enormously to institutional investors who calculate returns across asset classes. Third, and perhaps most importantly, futures markets saw unusual positioning. Large speculators reduced long positions rapidly. Open interest changed. The paper market, where prices are discovered, moved independently of physical market dynamics. Here's where it gets interesting. While futures traders were selling and prices were dropping, physical demand for gold and silver remained remarkably strong. Sovereign central banks, particularly in Asia and the Middle East, continued accumulating. Premium spreads on physical bullion widened. Delivery delays extended. Retail investors in certain markets actually increased purchases during the decline. This disconnect between paper prices and physical reality isn't new, but it's widening in ways that suggest the market structure itself is under stress. Understanding this split is crucial, because what appears on your screen as a price chart represents futures contracts and financial derivatives, not necessarily what's happening in the physical market where actual metal changes hands. When gold and silver prices fall, the immediate reaction from most observers follows a predictable pattern. They assume the decline means the assets have lost their fundamental appeal. They believe the safe haven narrative has failed. They wonder if they made a mistake. This reaction is understandable but misses the larger picture. Precious metals don't function like stocks or bonds. They're not primarily speculative vehicles or income-producing assets. They exist in portfolios for different reasons, as insurance against monetary system fragility, as stores of value when currencies lose purchasing power, as liquid hedges during financial stress. When you understand this role properly, short-term price volatility becomes less mysterious and less frightening. Consider how insurance works. If you carry homeowners insurance and your premiums increase temporarily, you don't immediately conclude that protection against fire or flood has lost value. You recognize that insurance pricing fluctuates based on risk assessment, market conditions, and other factors beyond your control. Yet when gold drops 20%, many investors panic and sell, effectively canceling their insurance at the worst possible time. The misunderstanding deepens because most people conflate price with value. Price is what markets determine in the moment, influenced by leverage, sentiment, technical factors, and short-term capital flows. Value is what something is actually worth based on fundamentals and long-term utility. These can diverge significantly for extended periods. Another critical misunderstanding involves timing expectations. Many investors enter precious metals expecting immediate validation. They want quick profits. They want their thesis proven within weeks or months. But monetary cycles move slowly. Currency debasement compounds gradually. Systemic stress builds over years, not quarters. When short-term price action contradicts their expectations, they lose conviction. They forget why they made the allocation in the first place. They abandon strategy based on temporary discomfort. Professional investors and institutional allocators think differently. They understand that volatility is the price you pay for holding real assets during monetary instability. They accept drawdowns as part of the process. They maintain positions through noise because their time horizon extends beyond the next market headline. This difference in perspective separates those who profit from market cycles and those who get shaken out repeatedly. If you study previous precious metal cycles, you'll notice consistent patterns. Major bull markets in gold and silver don't move in straight lines. They advance through stages with violent corrections along the way that shake out weak hands and create better entry points for patient capital. Let's look at the 1970s, perhaps the most instructive comparison to today. Gold began that decade at $35 per ounce, artificially fixed by government policy. By 1980, it peaked above $800. But that journey included multiple corrections of 20 to 40%. Each decline convinced observers that the bull market had ended. Each time, they were wrong. What drove that sustained advance? Monetary expansion, currency devaluation, rising inflation, geopolitical instability, and loss of confidence in fiat money systems. Sound familiar? In 1976, gold corrected sharply from the mid-1974 peak. Commentators declared the gold rally finished, yet within 4 years, prices had tripled again. Those who sold during their correction missed the most explosive phase of the entire cycle. More recently, consider the period from 2000 to 2011. Gold rose from around $250 to over $1,900. Silver moved from $4 to nearly $50. During that 11-year advance, there were at least 4 corrections exceeding 20%. Each felt significant in the moment. Each proved temporary in the larger cycle. The 2008 financial crisis provides particularly useful lessons. When Lehman Brothers collapsed and markets seized, gold initially fell alongside everything else. Liquidity disappeared. Leveraged positions were unwound. Investors sold what they could, not what they wanted to. But gold's decline during the acute crisis lasted only months. As central banks responded with unprecedented monetary expansion, gold resumed its advance and eventually reached new highs. Those who understood the cycle added to positions during the panic. Those who reacted emotionally locked in losses. Here's the pattern worth remembering. In the early stages of monetary crises, even monetary metals can sell off as liquidity evaporates. But as the crisis develops and policy responses materialize, those same metals become the assets that preserve purchasing power. We may be experiencing something similar now. The initial shock creates indiscriminate selling. Leverage unwinds, prices fall sharply. Then, as market participants digest the implications of policy responses, more money printing, larger deficits, continued currency debasement, the fundamentals reassert themselves. To understand what's really happening, you need to grasp several interconnected forces reshaping the global financial landscape. These aren't conspiracy theories or fringe ideas. They're observable realities, documented in central bank data, government statistics, and market behavior. Start with debt levels. Global debt, including government, corporate, and household obligations, has reached unprecedented levels relative to GDP. The United States alone carries over $35 trillion in federal debt, with annual deficits exceeding $2 trillion. These numbers grow regardless of which political party controls power. This debt cannot be repaid through traditional means. The numbers are too large, economic growth too modest, and political will for austerity non-existent. That leaves 2 primary options: default or debasement. Outright default is politically unacceptable and would trigger catastrophic financial disruption. So the more likely path, already underway, is gradual currency debasement through monetary expansion and inflation. The debt gets repaid in dollars worth less than the dollars borrowed. This process benefits debtors at the expense of creditors and savers. It rewards those holding real assets over those holding currency or fixed income instruments. Next, consider inflation dynamics. Official inflation statistics have moderated from recent peaks, leading many to declare victory over price pressures. But those figures are calculated using methodologies that understate true currency devaluation experienced by average households. More importantly, the structural forces driving inflation haven't disappeared. Supply chains remain fragmented. Energy transitions require massive capital investment. Labor markets stay tight in key sectors. Government spending continues at elevated levels. Meanwhile, the political pressure to provide relief through stimulus, subsidies, or debt forgiveness ensures monetary authorities can't maintain truly restrictive policies for extended periods. Every economic slowdown brings calls for easier money. Interest rates add another layer of complexity. Central banks raised rates aggressively to combat inflation, making gold and silver less attractive relative to yield-bearing assets. But these higher rates create their own problems. Government interest expenses surge. Debt service consumes larger portions of budgets. Economic growth slows, threatening recession. This traps policymakers in a dilemma: keep rates high and risk economic collapse or debt crisis. Cut rates and risk reigniting inflation. Neither option is painless. Currency pressure compounds these challenges. The US dollar's status as global reserve currency has allowed Americans to consume beyond their production for decades. But this arrangement requires foreign countries to willingly accumulate dollar-denominated assets. As US debt grows and monetary policy becomes increasingly politicized, that willingness erodes. We see this in actions, not just words. Central banks diversify reserves away from dollars into gold. Trade settlements occur in alternative currencies. Bilateral agreements bypass the dollar system entirely. This doesn't mean the dollar collapses tomorrow. Reserve currency transitions take years, even decades, but the direction is clear and the pace is accelerating. Finally, consider market structure itself. Modern financial markets operate with unprecedented leverage. Derivatives, markets dwarf underlying physical markets. Algorithmic trading dominates price discovery. Liquidity is abundant during calm periods, but evaporates during stress. This architecture creates fragility. Small shocks trigger large moves as leverage unwinds. Correlations break down. Assets that should move independently crash together. The system becomes increasingly unstable, even as it appears sophisticated. In this environment, owning physical assets that exist outside the financial system, assets without counterparty risk, without leverage, without digital dependencies, becomes not just prudent, but essential. While retail investors react emotionally to price drops and media headlines, institutional allocators and sophisticated family offices are making very different moves. These aren't secrets exactly, but they require attention to signals most people ignore. Central bank gold purchases provide the clearest indicator. Over the past 2 years, global central banks have bought gold at the fastest pace in decades. These aren't impulsive decisions by uninformed bureaucrats. These are calculated strategic moves by professional reserve managers with access to better information than retail investors will ever see. They're buying physical metal, not paper derivatives. They're storing it in domestic vaults, not foreign jurisdictions. And they're doing this while gold prices were at or near all-time highs, suggesting they expect much higher prices ahead, or they're preparing for scenarios where any price is acceptable compared to the alternative. Large-scale investors are also shifting allocations. Pension funds, endowments, and sovereign wealth funds traditionally held minimal precious metals exposure, viewing it as unproductive. But over recent years, many have quietly increased allocations, recognizing that traditional diversification strategies failed during recent market stress. When stocks and bonds fall simultaneously as they did in 2022, portfolios need genuine diversifiers, assets that respond to different forces and provide ballast during financial turbulence. Gold and silver, properly sized within portfolios, serve this function. Simultaneously, smart money is avoiding the trap of leverage. While speculative traders use futures and options to amplify returns, sophisticated long-term holders accumulate physical metal or fully backed products with no leverage. They understand that leverage transforms insurance into speculation, turning portfolio protection into additional risk. There's also movement in how these assets are held. Demand for allocated storage, where specific bars or coins belong to specific owners, has increased relative to unallocated or pooled accounts. This suggests concerns about counterparty risk, about the reliability of financial institutions, about the difference between paper claims and actual possession. This behavior reveals something important. Those with the most resources and best information are treating precious metals not as trades to flip for profit, but as strategic holdings for protection against specific scenarios they consider probable. Another signal appears in market structure. The gap between paper market prices and physical market premiums widened during the recent decline. When futures prices drop, but physical bullion trades at growing premiums to spot, it suggests the price discovery mechanism is distorted. It means demand for actual metal exceeds what derivatives pricing reflects. Professional investors notice these disconnects. They understand that paper markets can be manipulated or distorted through leverage and derivatives, but physical markets ultimately determine real value. When paper and physical diverge, smart money follows the physical. This doesn't mean conspiracy. It means market structure creates opportunities for those who understand the difference between financial claims and tangible assets. If you currently hold gold or silver either physically or through legitimate backed instruments, this moment tests your understanding and conviction, not your emotional resilience, your intellectual clarity about why you made this allocation in the first place. First, separate portfolio insurance from speculation. If you allocated to precious metals as diversification and monetary insurance, then short-term price movements are largely irrelevant. Your insurance doesn't lose value because the premium cost fluctuated. The underlying risks you're protecting against, currency debasement, financial system fragility, geopolitical instability, haven't diminished. If anything, they've intensified. Your allocation size should reflect this purpose. If you positioned precious metals as 5 or 10% of investable assets, a 20% decline in that portion has minimal impact on total wealth. You can withstand volatility because the position is properly sized for its protective role. If, however, you treated gold and silver as speculative bets on near-term price appreciation, using leverage or oversized allocations, then you've misunderstood the asset class. The current decline likely caused significant pain, possibly forcing liquidation at losses. This is the price of misalignment between asset characteristics and portfolio purpose. Second, avoid the temptation to make decisions based on short-term price action. Market bottoms form when maximum pessimism coincides with fundamental undervaluation. By definition, this feels terrible. If you sell because prices fell, you've transformed temporary paper losses into permanent realized losses. You've exited precisely when risk-reward ratios may be most favorable. History shows that successful precious metals investors do the opposite. They maintain or increase positions during fear, treating declines as opportunities rather than threats. This requires conviction based on understanding, not hope based on emotion. Third, consider whether the original thesis remains valid. Are government debts declining? No, they're growing. Are central banks demonstrating commitment to sound money policies? No. Political pressure ensures easy money bias. Are financial markets becoming more stable and less leveraged? No. Fragility increases despite temporary calm. If the reasons you allocated to precious metals still exist, if the monetary environment is deteriorating as expected, then price volatility is noise, not signal. Your thesis isn't invalidated by temporary market moves. Fourth, think about tax efficiency and personal circumstances. If you hold physical metal and face no immediate need for liquidity, there's no pressure to act. You can wait months or years for fundamentals to reassert in prices. If you hold through tax-advantaged accounts or face significant capital gains from previous purchases, the cost of exiting may exceed any benefit from redeploying capital. Each person's situation differs, but emotional reactions rarely optimize for tax efficiency or total portfolio outcomes. Finally, understand that volatility may increase before resolution. Markets trending toward major transitions often experience heightened instability. Prices whipsaw, narratives shift rapidly, information becomes contradictory and confusing. This is normal during structural change. Those who expect smooth, predictable paths during monetary regime changes are setting themselves up for disappointment. The journey is volatile. The destination, whenever it arrives, matters more than the route taken to reach it. If you size positions appropriately, have sufficient liquidity elsewhere, and understand why precious metals belong in diversified portfolios, then your task now is simple. Maintain discipline, ignore noise, and let the cycle play out. If you've watched precious metals from the sidelines, this moment presents both opportunity and danger. The opportunity lies in potentially acquiring insurance at better prices than existed weeks ago. The danger lies in mistiming, over-leveraging, or entering for wrong reasons. Let's start with what not to do. Don't rush into positions because you fear missing out. Markets that drop sharply often continue falling longer than seems rational. Bottoms aren't obvious in real time. What looks like a bargain today may look expensive next month. Don't allocate money you'll need for near-term expenses. Precious metals can remain volatile for extended periods. If you might need to liquidate within 6 to 12 months, don't enter. You risk forced selling at inopportune times. Don't use leverage or derivatives to amplify exposure. This transforms strategic insurance into dangerous speculation. It adds counterparty risk and time decay. It ensures that normal volatility can trigger liquidation even if your long-term thesis proves correct. Don't invest in precious metals to get rich quickly. That's not their function. They preserve wealth during monetary instability. They provide portfolio ballast. They offer optionality if currency crises accelerate. But they're not technology stocks or speculative assets designed for exponential gains. Now, what makes sense for someone considering entry? First, educate yourself before committing capital. Understand how precious metals function in portfolios. Study previous cycles. Read about monetary history and currency debasement. Know why you're allocating before you allocate. Second, determine appropriate position sizing based on total wealth, risk tolerance, and investment horizon. For most investors, allocations between 5 and 15% make sense as portfolio insurance. Enough to matter if thesis proves correct, but not so much that volatility becomes intolerable. Third, favor physical holdings or vehicles with genuine backing. Avoid complex derivatives, mining stocks if you want pure metal exposure or products with high counterparty risk. Simplicity and security matter more than cleverness. Fourth, consider averaging into positions over time rather than entering at once. Market bottoms are messy. Prices rarely fall to exact lows and immediately reverse. Spreading purchases over weeks or months reduces timing risk and emotional pressure. Fifth, prepare mentally for continued volatility. If you enter and prices immediately fall further, can you maintain conviction? If yes, you're ready. If no, you haven't done sufficient foundational work. Sixth, recognize the asymmetry. If the monetary crisis thesis is wrong, if governments successfully manage debt, control inflation, and maintain confidence in fiat currencies, then precious metals will underperform but likely retain substantial value. You might lose opportunity cost, but probably not catastrophic amounts. If the thesis is right, if monetary pressures intensify, currency confidence erodes, and financial stress accelerates, then precious metals could preserve wealth while many financial assets deteriorate. The downside is limited. The upside is significant. This asymmetric profile makes sense for portfolio allocation, even without certainty about outcomes. Finally, stay humble about timing. Nobody knows exactly when markets will turn. Not analysts, not institutions, not the person making this video. What matters is positioning appropriately before definitive signals appear, because by then, favorable entry points have passed. Regardless of whether you currently hold precious metals or not, certain behaviors virtually guarantee poor outcomes. Let's be explicit about what to avoid. Don't make investment decisions based on social media posts or YouTube comment sections. The noise-to-signal ratio is terrible. Most online discussion about precious metals involves either cultish enthusiasm or complete dismissal, neither of which serves thoughtful decision-making. Don't confuse volatility with risk. Risk is permanent capital loss or failure to achieve financial objectives. Volatility is temporary price fluctuation, insurance that declines 20% but ultimately performs its protective function during crisis hasn't failed. It's worked as intended. Don't anchor to previous prices. The fact that gold traded at X dollars last month tells you nothing about fair value today. Markets are forward-looking. What matters is future purchasing power, not past price levels. Don't panic during market declines or euphoria during rallies. Both emotional states cloud judgment. Decisions made during extreme sentiment typically prove wrong. If you can't maintain emotional equilibrium during volatility, your position is too large. Don't ignore liquidity needs. Precious metals shouldn't comprise your emergency fund or short-term savings. They're long-term portfolio components. Keep adequate cash reserves separately so you're never forced to sell at disadvantageous times. Don't expect validation from mainstream financial media. When precious metals perform poorly, mainstream outlets will mock holders as paranoid. When they perform well, the same outlets will either ignore them or claim the rally is over at every correction. External validation won't come. You need internal conviction based on understanding. Don't fall for numismatic premiums or collectible coins unless you're genuinely interested in numismatics as a hobby. For portfolio purposes, common bullion products offer better liquidity and lower premiums. Fancy marketing adds cost without adding protection. Don't compare your position to others. Someone else's allocation size, entry price, or conviction level is irrelevant to your circumstances. Focus on whether your approach aligns with your financial situation, risk tolerance, and time horizon. Don't assume past patterns guarantee future outcomes. Yes, studying previous cycles provides context, but each situation has unique characteristics. Probabilities aren't certainties. Maintain intellectual flexibility. Most importantly, don't position in precious metals if you haven't done the foundational work to understand why they belong in portfolios during monetary instability. Without that foundation, you'll exit at the worst possible time, locking in losses and abandoning insurance precisely when it's most valuable. The recent plunge in gold and silver prices has shaken confidence and created confusion. But for those willing to look beneath surface volatility, this moment offers clarity rather than chaos. What we're witnessing is not the failure of precious metals as portfolio insurance. It's the normal functioning of markets during transitional periods. Paper markets dominated by leverage and derivatives temporarily disconnect from physical fundamentals. Sentiment swings wildly, prices overshoot in both directions. None of this changes the underlying realities driving long-term precious metals thesis. Governments continue accumulating unsustainable debt. Central banks remain trapped between inflation and recession. Currency debasement accelerates gradually, then suddenly. Financial markets grow increasingly fragile, despite technological sophistication. In this environment, owning assets that exist outside the financial system, assets without counterparty risk, without reliance on institutional stability, without government promises, is not paranoia. It's prudent risk management. The smart money isn't making secret moves because they possess hidden information. They're making calculated moves based on probability, historical precedent, and understanding of monetary dynamics. Their advantage is patience, not prediction. Discipline, not divine insight. For those who already hold precious metals appropriately sized within diversified portfolios, this moment tests nothing except emotional discipline. Your insurance hasn't failed. Your thesis hasn't invalidated. Your task is simply to maintain conviction while others panic. For those considering entry, opportunity may be emerging, but only if approached thoughtfully, without leverage, sized appropriately and held patiently. Quick riches aren't the goal. Wealth preservation through monetary instability is the objective. The crisis referenced in this video's title isn't coming. It's here. It's been developing for years through debt accumulation, monetary expansion, and financial system fragility. The difference between crisis and catastrophe is preparation. Those who understand cycles and position accordingly will navigate what comes next far better than those who react emotionally to each market fluctuation. This isn't about fear. It's about realism. It's about recognizing that monetary systems operating on pure faith and exponential debt accumulation eventually face constraints. It's about taking responsibility for protecting wealth rather than assuming institutions will maintain stability forever. The path forward won't be smooth. Volatility will continue. Narratives will shift. Prices will frustrate both bulls and bears. This is normal during major transitions. What matters is understanding the larger forces at work, sizing positions appropriately, maintaining emotional discipline, and thinking in years rather than weeks. The noise will persist. The headlines will scream. The social media posts will panic or celebrate daily. None of it matters compared to understanding fundamentals and maintaining long-term perspective. Do your research. Know your thesis. Size positions thoughtfully. Control emotions. Ignore noise. Think probabilistically. Prepare for volatility. Focus on the long term. That's how serious investors navigate uncertainty. That's how wealth gets preserved during monetary transitions. That's the difference between reacting to markets and positioning for what history suggests comes next. The crisis is here. The question is whether you're prepared, not just financially, but intellectually and emotionally, to navigate what unfolds over the months and years ahead. Stay informed. Stay disciplined. Stay thoughtful.